Hello everybody, hope you guys are doing well. Today's video is also from, it's an incomplete records question, and there's an additional thing here that they've given you a markup percentage here in this question, and this is from basically from October-November 2021, paper 21, that is paper 2 variant 1. Question number 1, and it's both IGCSE and O-level, so it's pretty recent. This question says here, Shiv is a trader. His financial year ends on 31st August, which means his financial year starts on 1st September. He does not maintain a full set of accounting records. This tells me that it's an incomplete records question. But was able to provide the following information for the year ended 31st August 2021. So they've given you incomplete information basically. They've given you total revenue, that's the first value that goes in the income statement, and then they have given you markup. They've given you a bank account summary which has on the debit side obviously everything that all the money that is being received is recorded on the debit side. All the money that is paid out of the business is recorded on the credit side in the bank account. Then we have assets and liabilities at the start of the year, that is 1st September 2020, and at the end of the year, that is 31st August 2021. But if you look here, you just have a question mark for closing inventory. So they haven't given you a closing inventory. So whenever they give you markup, they make some value unknown. So when like here they've made closing inventory unknown. They have given you some more information, that is Shiv had withdrawn 900 for a family holiday during the year. He had included this in the expenses. So whatever expenses that they have paid, 34,000, in this they have paid 900 for a family holiday. So 900 should not be included in the expenses because for the expenses they have paid 33,100. And then they're saying on 31st August 2021, Shiv decided to create a provision for doubtful debts of 3% of trade receivables. We'll deal with this as we move on with the question. Here they are saying calculate purchases for the year ended 31st August 2021. But like I've also mentioned in the other video, that whenever we have to calculate purchases and we have trade payables at the start of the year, that is 32,600. We have trade payables at the end of the year, that is 29,600. And we have payments to trade payables. So that means we can use the purchases ledger control account to calculate purchases. So if you make the purchases ledger control account, because it's a total of trade payables account, you start with a balance brought down on the credit side because it's a liability. You write here 32,600. And then you write here purchases, which is unknown, which we are trying to find out from this T account. And then we have a balance carried down here, that is 29,600, and the payments that we have made. So we have recorded the payments on the credit side of the bank account, so we record this on the debit side of the purchase ledger control account. So you write here 257,700. On the top I'll write purchase ledger control account. It's always preferable that you guys write full forms in the final exam. Don't go for short forms unless you are very, very short of time. So when you find out purchases from here, you should basically get, the amount should be 254,700. That is the amount of purchases in this, basically in this question. The credit purchases is 254,700, and that's it for the purchases, credit purchases. So once they've given you credit purchases, now when we deal with markup here, what I need to tell you guys is that whenever markup is given in the question, you need to assume that cost, basically the cost of sales or the cost of the inventory is 100%. So whenever markup is given, you guys should know this, that it's like, for instance, I am purchasing a pen. So this is my pen, and let's say this is for 100 rupees. I got it for 100 rupees and I want to sell this in the market. So what I'll do is that I'll keep 25. I'll put 25 as profit on this, and I'll sell it for 125. That is what markup, that is how you deal with markup, right? So whenever markup is given, you assume that the cost of the product was 100% and you added 25% as a profit on this, and then you got a selling price that is 125%. So here when they've given you total revenue here is 320,000, and that is 125%. Like I know right now I gave you an example that if something is 100, you add 25 and then 125% is your selling price. 125 basically. So 320,000 is equal to 125%. So what is 100%? So you'll get cost of sales here. The X here will be your 100% and X is equal to, when you cross multiply this, like we do in math, you get to 56,000 here, which is your cost of sales. So now once you found out the cost of sales, it's very easy to find out the closing inventory because you have all the values. You have opening inventory. So basically the cost of sales is the formula, right? It's like opening inventory, add purchases, add carriage inwards, add subtract purchases returns, subtract drawings of goods, less closing inventory is equal to cost of sales. But in this question, we don't have carriage inwards, we don't have purchases returns, so we don't need to worry about it. So now when we make the income statement here, we start with revenue. So yeah, I write here revenue and I write here 320,000. And then I write here less cost of sales. After revenue, you normally subtract sales returns, but you don't have sales returns in this case. So we directly go to less cost of sales. Then we write opening inventory, which we'll take from the information in the question. The opening inventory here is 23,500, which I write here 23,500. Then add purchases, which I have found out from the purchases ledger control account. I know there is no cash purchases because if you look at the credit side of the bank account, you wouldn't find any cash purchases. You just have payments to trade payables, which means that we are only paying to our credit suppliers. That means we have made credit purchases, no cash purchases. So when you add purchases here, so the amount will be 254,700, which you need to add here. Then basically when you add both of these, so you get here 278,200. Then you subtract closing inventory, less closing inventory. Now I don't know my closing inventory here, so I'll keep it unknown. I don't know the amount, but I know my cost of sales. So here I write here 256,000, which I found out through cross multiplication, through the markup that was given in the question. Then when you subtract basically 320,000 minus 256,000 should give you a gross profit of 64,000. And this will basically come here as gross profit. Now when you calculate backwards, you can find out the closing inventory. So you write here 256,000 minus, so whenever you're calculating backwards, right? So whenever you calculate backwards, you basically have to subtract what is normally added, right? So whenever you're calculating backwards, so we have 256,000 here, that is our cost of sales, 256,000, and the addition of opening inventory and purchases is 278,200. So when I subtract both of these, 278,200, I get here 22,200. There is another way of calculating. I just want to add this here because whenever there's this kind of data in MCQs, the students need to use the formula for cost of sales, and the formula for cost of sales is pretty easy. You write here opening inventory, you add purchases, you subtract purchases returns, you add carriage inwards, you subtract drawings of goods, you subtract closing inventory, and that is equal to cost of sales. So here when we applied the same thing here, we started with an opening inventory of 23,500. We added purchases to 54,700, and then you don't have purchases returns. You don't need to worry. There's no carriage inwards. There's no drawings of goods. So less closing inventory, that'll be X, and then you get a cost of sales of 256,000. So when you solve for the value of X, you find out 22,200 is your closing inventory, which we find out from the income statement by going backwards in calculation. So here we get a gross profit of 64,000. Then we have to see if we have any other incomes here. So total revenue was given here, that was 320,000. It was a combination of cash sales and credit sales. There is no other income. I know this because on the debit side I don't see any other income, any other receiving of money on the debit side of the bank account. So I just move on to less expenses. Now here we have expenses, like it's like all the expenses that were paid was 33,100. That is the expenses that we have paid, because 34,000 is the total that they have paid, but 900 was Shiv's personal expense, which was for his family holiday during the year, and that should not be included in the business expense. It should be treated as drawings, because when the owner undertakes any personal expenses from the business bank account, we should treat it as drawings. So here, when 900 is drawings, so when you write here expenses, so expenses, they have given you expenses as a whole, you write here 34,000 minus 900, and then you need to subtract the closing owing. So add the closing owing basically. So when expenses, there is an owing at the end, and owing is always added. So when you add 400 to this, you get 33,500 for your expenses. There is no opening owing, so we don't need to worry about it. You don't need to make an account as such as well, because there is no owing at start. But just add the closing owing. Closing owing is always added. And then the next expense here will be provision for doubtful debts, which needs to be created. So provision for doubtful debts. Okay, when you calculate provision for doubtful debts, you do here, basically they've given you 3% of trade receivables. So 3%, and trade receivables at end here is 25,900. So you write here 3% of 25,900, and you multiply this and you get here 777. Okay, the next thing, the last thing here is depreciation. And in any incomplete records question, you might not find depreciation very direct, but there is always depreciation that is taking place. You have equipment at net book value, but at start you have no equipment, so you don't have any net book value at start of the year. But then during the year, we had purchased equipment for 16,000. So the cost of equipment during the year that was purchased was 16,000. In the end, we are left with the net book value of 12,800. So whenever we purchase something, the cost, a non-current asset, the cost and net book value of the non-current asset is the same. But what happened was that during the year, of course, it got depreciated. The asset got depreciated, because of which the net book value is now, the remaining value is 12,600. So when you subtract both of these, you don't have any sale of non-current assets. You just have one purchase, and in the end you have a net book value of 12,800. So now what you do here is that you just subtract both of these values. So depreciation, when we calculate depreciation for equipment, you subtract 12,800 from 16,000, so you get 3,200. And when you add these three amounts, you get 37,477, which when you subtract from 64,000, you get 26,533, 523, and that is your, and this is your profit for the year. Now, once the profit for the year is here, so we have, this was for 11 marks, and this is good 11 marks. I find it pretty easy if you follow the rules. So the next thing here is name the accounting principle Shiv should apply when recording the 900 he had used for a family holiday. So like I told you, when the business owner takes some money out of the business to pay for his personal expenses, it's called drawings, and it should be treated as drawings. And the concept here that is being applied is business entity concept. Business entity concept says that the owner is a separate being and the business is the separate being. So whenever the owner takes out money for his personal expenses, it should be treated as drawings, and you should show it, like you should show that this amount of money, or these many goods were taken out by the owner for his personal use, and that basically reduces his capital as well. So in the next part, they are asking you, Shiv has always valued his inventory at cost price. He's considering valuing the inventory on 31st August 2021 at selling price, as he believes it would result in a higher profit for the year. It is true that if you overstate closing inventory, so you guys should know this, that overstatement of closing inventory, when you overstate closing inventory, your profit is also overstated. So closing inventory results in a lower cost of sales. Overstating closing inventory results in a lower cost of sales, which means that you have a higher profit for the year. But is this profit higher profit, but is this profit going to be true and fair? Because you have overstated closing inventory, and the rule for closing inventory and any inventory valuation is that you value your inventory at lower of cost or net realizable value. So if you value your inventory at selling price, which means it's a very obviously selling price includes profit, right? So if you value your inventory, the remaining inventory that is left in the business which has not been sold, that is the closing inventory, right? So you can't overstate it like this, because this will go against the principle of prudence that says that you don't overstate your assets and you don't overstate your profits. If you overstate closing inventory, which means your profits will be overstated, and then in the statement of financial position, when you value your inventory at selling price, that means your total assets will also be overstated. That is, total current assets will be overstated, hence your total assets will also be overstated. So now your financial statements will not show a true and fair value. So also this will go against the concept of prudence, which says don't overstate profits, don't overstate assets. So you go against the concept of prudence. Also, you write prudence concept says that you don't overstate your assets, don't overstate your profits. And also the accounting records must show the true and fair picture of the business, which will not be shown here because assets are overstated, profits are overstated. Also, the information is not comparable anymore with the other accounting years and with the other businesses that you are trying to compare yourself with. So you need to advise Shiv that this should not be done because it goes against the accounting principle of prudence, which every business needs to follow for their accounting information. And basically write everything that is important here, that overstating closing inventory will result in a lower cost of sales, and therefore profits will also be overstated. Lower cost of sales means that, okay, if you need to understand this, right? So closing inventory, whenever you overstate closing inventory, which means you're subtracting a bigger number, right? Because closing inventory is subtracted. When you subtract a bigger number, you get a lower value for cost of sales. And then when cost of sales is lower, obviously revenue minus cost of sales gives you gross profit. So if cost of sales is lower, your gross profit will be overstated. That effect will also be carried down to the profit for the year. So both will be overstated then. So that's it for this video. Thank you so much for watching.